We're going to talk about what's going on around the world. So let's kick things off. But before we do, just a brief disclaimer. This content has been prepared by MacroVisor and is presented for informational purposes only. MacroVisor is not a broker-dealer and does not provide investment advice to individuals. So just be aware, we're doing this to help provide some information, our research. Of course, this is a summary level view. We have a much deeper view coming up on our website for our members, including actionable strategies based off of our research. So first things first, let's get into the global outlook. Where do we see things going this quarter? One thing that's really interesting is the relationship between the Fed and the rest of the world. It really is, in many ways, often a trend setter. So right now, we're looking at the next credit cycle being delayed, not canceled, but potentially forestalled. And it has a lot to do with fiscal excess. And this will be a theme that we come back to often as we talk about why rate cuts have been delayed, not just in the United States, but around the world. As the CHIPS and Science Act and Inflation Reduction Act, ironically named or not, continues to push liquidity and continues to stimulate not only the U.S. but global economy, that more than offsets the Fed tightening. And as a result, that's delayed the Fed's cutting. And so we see that also having an effect in some of these emerging markets.
And hello, everyone. Thanks for joining us today. So talking about the emerging markets, so at the beginning of the year, we were quite excited to see, the cycle kind of begin for emerging markets, the easing cycle, or let's say more the normalization cycle. But it hasn't been smooth. Obviously, nothing has been very smooth when it comes to most of central bank policies. But this time around, it's been even more challenging because of the Fed. Now, we'd expected that the easing cycle would go on and maybe with one pause and then a cut. But many of the countries have refrained from easing, and some have even hiked. For example, Philippines did a surprise hike. Now, this is because most of the world's commodities are priced in US dollars. So with the Fed holding higher for longer, we get a stronger dollar. And a stronger dollar means these countries, these emerging markets, having to either pay more for the commodities or having to buy less, which means scarcity, right? So either way, you have higher prices, which brings in inflation. So for countries who have been contending with inflation and thought that, they've conquered inflation and they could start cutting, they're having to pause now. The other thing about a weaker currency, local currency versus the US dollar, is that much of their borrowing is also in US dollars. So many of these countries have foreign currency debt, which is in US dollars. And paying back this debt means it gets more expensive for them when their exchange rate starts to fall, right? So when their local currency starts to depreciate, paying back in dollars starts to become more expensive. Now, some of the countries do have adequate reserves. India, for example, is one of them. So their currency, they've been defending their currency quite well. There are a few other countries as well that have adequate reserves, like Peru, Angola. I want to say Russia and Bulgaria as well, but Russia doesn't count. But overall, most countries don't have adequate levels of reserve and therefore can't really defend their currency as well as some of these other countries. And therefore, it's been very difficult for many of these countries to cut rates. We've seen that even in China, for example, where the yuan has been depreciating and they keep trying to fix it at higher levels.
And China's recovery is stalling as well. And it seems like that's one of the reasons that, we kind of see the urgency for these central banks to try to stimulate, but at the same time, they don't have the all clear from the Fed. And it seems like another area that the emerging markets are sensitive to is all that dollar denominated debt. If the dollar rises, if they're cutting, it becomes appreciably more expensive to try to service that debt. So that's another consideration here, right? But Aisha, you cover China quite closely, and we've seen for years promises that the government would step in, that they'd create this outsized stimulus, that the economy would grow. Yet it has not happened, right? So it's been this slowdown. So for folks out there, we're going to cover China more in depth as the slideshow goes on. But Aisha, did you want to share just a quick thought on the Chinese lack of recovery and how that kind of counterbalances that economic growth cycle, and that we're not really seeing it? There's a lot of slack there because of the real estate debacle and consumers sort of checking out.
So China has an interesting situation. We've been covering it all year in details. They've tried to shift their focus to more high-tech manufacturing, and that's why they're accepting a lower level of growth. This is the government. But at the same time, their property market, I want to say, is in shambles, right? And they have debt that is, being defaulted on. And their local government debt is extremely high. And so they're facing challenges on the one hand, which needs to be addressed, but the government is not addressing because they're thinking shifting the focus to high-tech manufacturing is far more important. Or at least this is what it seems like from the outside. Now, they tried to do some fiscal stimulus. Obviously, it wasn't enough. And we'll have to see how they take it forward from here. But we have some more detailed thoughts about the quarter coming up and where we see China going in the following slides.
And the other area is China is such a large consumer of commodities that we have to be a little more cautious here. For example, with commodities like copper, where China uses about or more than half of the world's copper, we have to be a little more cautious because we've seen some things get more out of balance. And we'll talk about that. But in essence, outside of energy, we're just a little bit more cautious on some of these key commodities here because of what we've seen, because we've had a good run. And, for our members, we've actually caught a good chunk of that run in some of these key commodities. If you follow the dashboard, every week we track the momentum and the trade opportunities in all of these global markets, whether it's equities, commodities, currencies, rates. It's a lot of fun to kind of drill down in the week to week momentum and see what kind of macro trading opportunities come up from that. So finally, in our global outlook, we're also concerned that there are growing downside risks for developed economies. And has everything to do with this sort of delayed but not canceled credit cycle. The Fed is not able to start the new global credit cycle. That has a downward effect on economic growth. And on the other side, that fiscal excess is likely to start to run out as we get closer to 2025 and political gridlock becomes a bit of a bigger issue potentially. So we can see the global liquidity index on screen suggests that we should be up and away. But the reality is we may need to exercise some more patience here for this new credit cycle to get going full steam ahead. So let's talk a little bit about precious metals. They are, of course, on everyone's mind. They've had an absolutely stellar run. You look at gold making multiple new all-time highs. It is still close to the top of its trading range. And yet, there are some risks coming into view here. And this is something that we need to address because over the long term, we're still bullish on precious metals. But in the near term, we are concerned that we could have choppier trading conditions. Both gold and silver have been trading largely in a range for an appreciable amount of time for them, really for months at this point. And we can see there's been this enormous divergence between the price of gold and real yields, which are inverted on the chart on the right. This is unusual. This chart, really as far back as you go, there's often a decent relationship between real yields and gold. And if you think about it, it's because the higher real yields go, the more that treasuries act as a risk-free way to generate income versus gold, which is more driven by psychology and momentum, and of course doesn't produce any yield at all, right? So the problem ends up that if treasuries are a attractive alternative, often that pulls the price of gold lower as investors shift their allocations. That has not happened this time, and there are reasons for that. Increased central bank appetite for gold. We've seen record accumulation. We've seen emerging markets like consumers in India and in China allocating heavily into gold. U.S. retail is starting to get more interested in gold. There's increasing uncertainty globally from a geopolitical, monetary, and political perspective. That's also increased appetite for gold because, in our view, gold and precious metals to some degree in general are not really inflation hedges. They are uncertainty hedges. And so as uncertainty rises, so too typically does the price of gold. And that is likely the explanation for this divergence, but it's also a reason that we need to be somewhat concerned about where it goes from here. That is to say, we would not be terribly surprised to see gold pull back a little bit or at least continue to consolidate. Things can correct in both price and time. A correction in time is more of a sideways consolidation, and we have seen that. We also have the delayed global cutting cycle. Gold loves liquidity. It loves lower interest rates. We're not necessarily seeing that. So again, going back to the real yields versus gold chart, that's another thing. We'd love to see real yields come back in a bit, right? That would also give us some more confidence that precious metals can run. And elevated inflation. Again, I know the common thought is, well, if inflation's high, gold should run. But the truth is the data doesn't necessarily speak to that. And inflation tends to push rates higher. And if real rates move higher, that often does put some pressure on gold. So that has us a little concerned. We're still mindful there's that divergence there. So maybe that relationship isn't as strong as it once was, but it's still something we need to keep in the back of our minds. And then finally, with prices as high as they are, you've got more mines bringing on production. You've got an increase in supply, and that can be something we have to take into consideration. As has been said, the cure for high prices is high prices, right? When prices move up, typically production increases. So we are cautious on precious metals over the next quarter. We do need to see them break out of their ranges to become more constructive, and that's something we follow week over week in the dashboard. So this view can change. We're very dynamic. Even though we look at the big picture and sometimes those pieces can take time to move and come into trends and thematic areas where they're trading and investment opportunities, we also track the momentum because our view is macro meets momentum, creating opportunity. And so if gold breaks out of these trading ranges to the upside, we're going to get back bullish on gold and its miners from here. Similar with silver. Over the long term, we're constructive, allocating up to 5% of portfolio liquidity into precious metals as a hedge against uncertainty. Industrial metals, we focus primarily on copper and platinum with these for our dashboard. And so that's what we're going to cover today, primarily looking at copper. And you can see on the chart on the right, positioning in copper based on the commitment of traders data is still very extended. So that gives us a little bit of pause. Now, we've made some progress in two other areas of concern that we've talked about on our dashboard. One of them was the premium between copper that is traded in the US and copper that is traded at the LME and Shanghai. You would think if China is the biggest user of copper and copper prices are appreciating, they should be appreciating in Shanghai like they were in the US. That was not happening. That was one red flag. The other red flag was extreme backwardation. Now, yes, there's a global deficit in the supply of copper and platinum. But when you see extreme backwardation to that degree without the stocks of copper in China being depleted, in fact, quite the opposite, they were rising at the time, that gives you a sign of concern as well, because backwardation should mean there's a lack of near-term supply. If that is not happening in the fundamentals of supply and demand, then instead backwardation indicates an excess of near-term speculation, which is exactly what happened as copper was exceeding $5 and everyone in the world was talking about getting long as we were talking about getting more cautious to our members around that time. We are looking at 427.50 as an area where support may come back in for copper. It's at least a key level on the chart that we have our eyes on, but we also want to see some of this speculative excess work its way out. China accounts for half of global copper consumption. So if China's demand for copper is not really building from here and their stocks continue to rise, that's another area of concern that we're going to continue to monitor. Now, so over the next quarter, we are cautious. We're underweight industrial metals and miners. We're still in Freeport McMoran. We'll stay in that stock, but we want to build that position after we see this excess flushed out. So long term, we're constructive on these miners, on the commodity itself. The long-term picture for copper is incredibly bullish. That's why people got so excited. We get it. But we also have to be concerned about excess. And we saw that excess. We identified it as it was happening. And now we're starting to see that natural corrective cycle come into play. So we still are constructive on copper and platinum. Platinum has a similar deficit over the long term. These are areas where we want to be constructive on both the commodity and their miners, but we need to see things settle down before we start to rebuild those positions. Next up, let's talk about crude oil, Aisha. You've been covering this one closely, and it's been an area of a lot of interest globally.
That's right. So we talked about what we talk about here is the short-term outlook, right? The next 3 months, because we're covering the quarter. And we're in a window of opportunity here when it comes to crude oil. So we expect Brent to remain between 83 and 85 per barrel. Or rather, we forecasted this. And then WTI crude, which is the US crude oil, to remain between 77 and 80. Now, we're already overshooting this target, but our overall view is bullish, so it's good if we're overshooting the target. And this is because we see, a lack of supply. So, in general, there is a seasonality factor that plays out here, right? Because of summer, because of driving season, because of travel. So global demand usually increases by about 3 to 3.2 million barrels per day between May and August. Now, this year, we've seen quite a bit of, reserves or stockpiles already built through the second quarter. So that sort of lowers the requirement a little bit. We are also seeing lower demand from China. So on the supply side, we have some stockpiles. And also we have the OPEC plus cuts still in place. And then on the demand side, we're seeing lower demand from China, but some of that is expected to be offset by a hotter summer. So all in all, we kind of forecast $1 million barrels per day deficit in Q3. And that's quite sizable. So if you see the chart here, you can see that this is quite a sizable deficit in the third quarter. But this will start to reverse in the fourth quarter as we see OPEC Plus roll back on their production cuts gradually. It's not going to happen all at once. So they're going to gradually unwind those cuts. And therefore, there's going to be more supply coming into the market. There's also the situation where U.S. production increases slightly more in quarter four. So everything considered, we think this could keep prices supported during the summer period. And if you look at seasonality, it's always the case that we see a spike in oil during this time. So we are bullish for the quarter. And overall, we are long-term bullish on crude as well. We've talked about this a few times, but just to make it very short, we do have a lack of supply overall in energy. So I know we're trying to move towards renewable energy and clean energy, and we should be doing that. However, we can't do that all at once. That's the argument. And therefore, we will need crude oil to support our energy needs, our global energy needs, even in the long run. And when I say long run, I mean 3 to 5 years, maybe even until the end of the decade. So something to bear in mind that overall crude oil prices will be supported during this summer period.
So Aisha, that's really helpful to get some context on what you're looking at with crude. And I know we're in a pretty interesting period of time here because we have some right tails out there on the horizon that could play out. We've got an increase in severity of weather that could hit production and refining in the Gulf. And then we also have an increase in geopolitical tension. So with what you've discussed, does that account for some of those right tail scenarios that could emerge?
Actually, it does not. So, this is based simply on supply and demand fundamentals. And so, if we do have some of those right tail risks, we could ideally or arguably see crude prices go even higher.
That's very interesting. I think that's something to keep in the back of our minds as well. And this is one reason that I don't think there's any reason to have a short bias here. You can be neutral, you can be long. Probably best to be very careful with shorts. The reason I say that is I keep hearing folks calling for crashes in crude. They've been calling it for those for a long time. It has not come to fruition. Maybe someday it will, but this is not the time of year to be very bearish. Just my own 2 cents on risk management. Let's talk a little bit about rates. And it's interesting because crude has a pretty direct relationship with rates. So we can't really talk about one without talking about the other. It's actually a very interesting area of study for me. I love intermarket dynamics. And what I see with crude in the 10-year yield is there's typically about a 4 to 6 week delay between an increase or decrease in the price of crude passing through to yields. And I think the reason for that has to do with the way it passes through to the data, because crude tends to boost CPI. In fact, last month in May, one of the big reasons the headline was weaker was because gasoline prices dropped. And so if crude prices are appreciating again, which they are in June, that suggests June's data that we get later in July could be appreciably warmer than what we saw, which could push rates higher. And that's what we're thinking about. As we get into quarter three, we're looking for increased volatility in rates. We've seen that as a theme really starting over a week ago, that rates have started to become much more volatile. And we're also seeing that in commodities and in currencies. I mean, look at what's going on in the yen. It's hard to ignore the volatility. So volatility in rates is a theme. We think the move index can move higher. We also think rates can move higher in quarter three. And there are reasons for that. And these are familiar reasons to our members, as we've been covering this as one of the key reasons that we were actually bearish on the mid to long end of treasuries going into this year. Remember, going into this year, the market was looking for 6 to 7 cuts. We were not. We were looking for 2, basically. And we may not even get that many cuts. So at this point, rising deficits, resurgent inflationary readings, like what I just talked about, the potential for energy to push those readings higher this month, and a large supply of issuance could push rates higher. 2 pro-inflation and deficit spending candidates may also add to that pressure, because if you're taking duration risk, you've got to think about not just what's happening now, but really what's happening over the course and where you'll be holding that paper. If you're buying a 10-year note, you've got to think about what does the next 10 years look like, for example. Japan, the world's largest holder of treasury paper, is also likely to sell down exposure to defend the yen. We've seen potentially some of that as one of the reasons for that upward pressure in rates. We believe the 10-year rate will average above 4.5% for the third quarter, so not appreciably higher from here, but at least getting above that line in the sand where we become a little bit more concerned about risk assets, and particularly longer duration risk, small caps, things like that. So investment considerations, let's be clear, we still love bills. Bills are great, because you can get exposure to a bill. You really don't have any downside risk if that's liquidity you're not going to have to harvest, right? Because you don't have to sell it. You just let it mature and buy more bills. And if the situation changes where there's an appreciable premium on the long end and it's time to start rotating to longer duration, not only will we talk about that in the dashboard as we shift our fixed income views, but in addition to that, that'll give us the ability to rotate out of those short-term bills to longer-term exposure. So we don't feel the time is right for that. We don't feel at this point, with no term premium on the longer end, that it makes sense to start buying into those. What would change our view? If the economy weakened materially, then they're more of a hedge for downside economic weakness. But for now, we like bills. We like shorter term duration. If we want to get longer term duration, we're more tempted to talk about AAA corporates and tax-free high quality municipal debt. So we're still bearish on notes and bonds, and we actually think we're in a secular bear market for treasuries, so we're cautious over the longer term as well. So let's first talk about the United States. We all know the AI narrative has been a huge theme for the country. It has led the market to all-time highs. In fact, we've had the most all-time high prints in decades this year, one after the other, led by the Fantastic Five. We've seen the rally broaden out a little bit more of late. But you can see on this chart from Ned Davis Research that this has been a very narrow rally overall. In 2024, it's been the lowest percentage of S&P 500 stocks beating the index ever. And it's also been the most concentrated that we've seen the largest components of the index become ever. Now, what does that mean? It means we have a sort of forked path in front of us as to how this could play out. To contextualize what it's looked like in the past, for every bull market from a bear market low since the late 1980s, equal weight and small caps have led the way. They've outperformed the market cap weighted index. That's not the case this time, but there are reasons. And that has to do with where earnings growth has been. It's been largely in the mega caps, and so that's where investors have been chasing returns. So we kind of look at this as an inflection point. We believe that the rally could broaden out from here, and that would be the healthiest scenario, because that would lead us to more sustainable gains, a sort of rotational theme into lesser loved parts of the market. The other area of possibility is instead that you have a bit of a risk-off event that hits one or more of these larger players, and we get a correction instead of a broadening out. Or, of course, we could have more of the same. We could get more stretched. We could have more concentrated performance in these really, really large players. Our view is it's more likely that it's one of the first two scenarios, either a broadening out rotational theme or a correction from this concentrated performance. So that's our larger view on the United States. The other thing that we're really looking for to validate the AI theme, and we've been talking about this as sort of the rubber meets the road. We need to see earnings expansion and productivity increases directly attributed to AI. If we see that, then we could have some chance for this to really become validated, because it's the technology is proving its usefulness to companies. That's something that we have our eyes on as well with quarter two earnings and quarter three earnings, of course, is do we see companies say, hey, we're increasing our margins and productivity because of the AI tools we're adopting? Then we could actually see this really broaden out for other reasons, that, AI is actually building that earnings momentum in a broader swath of industries. So over the short term, we're bullish of energy stocks, aerospace and defense, low beta dividend payers, and key cybersecurity and SaaS names. And one reason for that is software as a service is objectively cheap in many areas, especially compared to the kind of performance we've seen in semiconductors. So we really think the rally in tech itself needs to broaden out. One of the names we recently identified that's showing some of that strength is SentinelOne. Another is Palo Alto. We think these types of names that have been beaten down, Oracle is another on that list as well, that we've identified during drawdowns, and it's been a great opportunity to scoop it up. These are the types of opportunities that are lesser loved, lesser known, that could have appreciable upside, particularly if the rally broadens out. Long term, we're bullish on the United States, and it's hard not to be. And we would like to see a broadening out of that rally. That's really what would keep us bullish. And we'd be attracted to the lesser loved players with strong free cash flow and clean balance sheets in that environment. Next, let's go to U.S. earnings. And Aisha, let's talk a little bit about what you saw in the last quarter and lead us into what you're expecting for quarter two.
So this quarter, we're supposed to have a bumper earnings season. Now, we've been talking about an earnings recession last year, and we were quite right. We were on the mark when it came to, talking about that earnings recession and that kind of pulling down the market. But that's ended. So now we're no longer in an earnings recession. We're in an earnings boom, if you want to say. Last year, 2023, closed at 1% for the SPX, for the entire SPX, 1% year on year. This year, we're supposed to get something around 11.5%. And so if conditions are right, we might actually achieve 11.5% on the S&P 500 for 2024. And speaking of high estimates, this time around, we're expecting, or the market is expecting, an 8.8% increase year on year in EPS growth. And if you look at the chart, you can see that that's quite significant when we compare it to the last few quarters, right? Now, this time as well, we expect the equal weight, or rather, I wouldn't say equal weight, I would say the SPX minus the MAG 6 to actually post a positive earnings. So that's 494 stocks or 494 companies that are expected to post their first positive earnings growth of 5%, which is significant. So with the bar set this high, we have to understand what happens next, right? So last time around, the bar was set quite low. Earnings expectation, I want to say, was around 1% or maybe lower than that. Around, I think, 3 to 4%. I think that's what it was. And we had a number of beats. And those beats were rewarded, but misses were punished very hard. And the reason for that is because the bar was set quite low. Now, this time around with the bar set higher, we're likely to see beats rewarded in an outsized manner, because if your estimates are so high and you're still beating them, that means, you're doing really, really well. But on the other hand, misses may not be punished as hard because, again, the bar is set so high. And if you're missing by a little bit, I don't think anyone's going to mind all that much. Now, what's been unusual is usually after Q1, we see a revision in estimates. And that revision usually comes around 3%, maybe even more. This time, the revision has been minimal. So it was 9% at the end of, I want to say March 31st. Yeah, so at the end of March. And now it's come down to only 8.8%. So a very, very small change in estimates after the Q1 earnings season. So again, these estimates are not just, I want to say, high, but at the same time, there's great conviction in these estimates as well. Now, no surprise, the leaders are still going to be infotech. So we're going to see comm services and tech, kind of beat. The laggards here are going to be materials, industrials, and staples. Energy is expected to have a decline in net profit, but still expected to post positive earnings growth this time. And finally, we are seeing a bit of a handoff that Mehan talked about, the broadening in the market. So a little bit revenues for the MAG 7, I want to say MAG 6 rather. So this is ex-Tesla. Revenues for the MAG 6 are expected to slow, still positive, but slow down a little bit. And the rest of the market is expected to pick up a little bit more. So we are seeing that handoff, or expectations of that handoff, starting very gradually this quarter. And that could be helpful because that could actually help the market broaden out, something that we need to make this rally less scary. I mean, the rally's been great, but it's a very scary rally, right? And this earnings season could actually change some of that.
Absolutely. Great points there, Aisha. Really appreciate that because it provides some context as to what we should be looking for. Is it really going to be a continuation of these gangbuster earnings in these really large companies? And are we going to start to finally, as you said, see the inglorious 494 actually broaden out a bit? So we'll be watching closely for both the earnings and the market reaction and covering that as the quarter goes on. Now, next up, we have Japan, and this is a country that you've done a great job covering. Last year, we had a fantastic trade long Japan. Recently, you talked about, in a very prescient way, reducing exposure to EWJ because that non-hedged ETF started to show weakness as the yen fell. And for folks out there not watching what's going on in Japan, the yen is down over 50%. Just over the last decade, about since 2012 or so. So it's an incredible situation. What do you see going on in the country for Q3?
So I think you've hit the nail on the head. The Japanese yen continues to be the centerpiece of discussion. It hit new lows, as you rightly pointed out. And because of this, the Bank of Japan is now under pressure to tighten and stabilize the currency. Um, they've been looking at inflation taking hold in the country. It seems to be working contrary to what they wanted. So now inflation, I want to say, I won't say it's completely stable, but it's quite stable now. And it's about time that Japan starts tightening even further. So they did do a rate hike, but that was like a nominal or like a small rate hike. And they need to tighten further. The focus for July, however, will be the taper of bond purchases. Now, this chart shows you in yen, in trillions of yen, how big the Bank of Japan's assets are, right? And they have been increasing all throughout. So they need to taper their bond purchases to sort of tighten the market. Last time around, even though they hiked, because they didn't make any change to the bond purchases and conditions remained easy, the market actually went up and the Japanese yen actually went down, so depreciated, right? So it's the opposite of what would happen after a hike. So liquidity is everything. So the focus will for July will be tapering of bond purchases and pulling out some of that liquidity from the market, which could put pressure on Japanese equities in the interim, right, as the liquidity gets pulled out. And Governor Ueda actually came out in June and said that it's going to be a sizable reduction. So we don't know what that sizable reduction is, but he definitely tried to scare the market there a little bit. Now, on the positive side, though, real GDP growth is set to flip positive, if not in Q2, at least by Q3, and we'll get that result obviously in Q4. But post this liquidity event and perhaps another tightening coming in September, we might see conditions reverse and become easier or at least better for equities, because the rate increase might actually pull back funds from overseas and fuel domestic consumption. So as inflation, sort of stabilizes and starts to come down in many other parts of the market, which is actually hurting domestic consumption. Even yesterday, we got household spending, which turned negative again. Real household spending turned negative again. And so we need that consumption to start, and that, will help GDP growth and will likely help equities again. So we are overweight overall in the long term on Japan. But for the time being, we are trying to be neutral here because we're not sure how equities will behave once that liquidity gets pulled out.
Thank you, Aisha. Let's move right along to another country in the Pacific. That's South Korea. And this is a nation that is one of the largest exporters, the seventh largest. So they're heavily reliant on the whims of the global economy, and particularly electronics, semiconductors, of course, being a major in that category. Hynix is NVIDIA's biggest memory supplier, for example. And they also are a big exporter of durables, appliances, cars, all this sort of stuff. So it's incredibly important to pay attention to South Korea because it's usually a leading economic barometer for the global economy. And the country has benefited from increased demand for these semiconductors and durables, leading it to see a huge trade surplus. But it hasn't translated to GDP. As we can see, it's relatively flat. So for our view on South Korea, because we're not really seeing this big surge in trade translating to GDP, they do have some issues in their real estate sector. They've kind of recovered, but it's steady as she goes. So I would say at this point, we favor de-risking because we do believe that we've had a great run in these equities, and there are more risks to the downside than to the upside for these flows. That is to say, until a new credit cycle starts, we believe these cyclical demand flows for semiconductors and durables may be closer to their peak than their trough, right? We've had such a huge run that it makes sense to take some profits here. And these are areas we talk about on our dashboard, right? So when we provide our views every week, we talk about what we see with the momentum and any key macro developments with these countries. And with South Korea, we identified the breakout. We are becoming more cautious here, and we want folks to know we're still bullish on the long term. And we would rebuild positioning in South Korea and equity exposure on a significant pullback, because the view over the next 5 or 10 years is really it's going to be a great place to invest. But also, we want to get good prices on those investments. And we think there's a decent risk that we could have a sale here. So we want to be positioned for that with some cash on the sidelines, harvesting profits in South Korea and looking for an opportunity to get long again at lower prices. Next up, we have China. And Aisha, you gave us a preview during the global outlook. Let's dive in. What do you have on your mind with China? Because I've been following this one too, just watching how for years they promised and haven't delivered. They've talked about how they're going to try to turn this economy into one that's a little bit more sophisticated, a little bit more higher end. You were one of the first people I heard talking about that pivot. And indeed, it's been a big reason why there hasn't been the kind of performance that people could expect. On the other side of it, we've seen concerns growing that the real estate situation in China is not only unresolved, but could worsen as time goes on. What do you think about everything going on there?
So that's right. We talked a bit about it in the beginning. Now, a big news last quarter were the fiscal measures that, China started to roll out. And this was big news because all this time, so all throughout 2023, we kept on saying that we really need fiscal measures. We really need fiscal measures. And so when they did it, everybody was happy. The market celebrated. But soon enough, people started to realize that these measures were not sufficient, right? And they did almost nothing to sort of supercharge the domestic consumption. If you look at consumer confidence on the right, you can see it's still at rock bottom levels, nowhere even close to pre-pandemic levels or 2017, 2015 levels. So domestic consumption, the domestic economy, the property market have all been in trouble. Now, the other side of that was supposed to be you do some fiscal measures which are adequate, and then you also do monetary policy support, right? Which also they didn't do. So all throughout Q2, I want to say there were like at least 5 different analysts who were calling for rate cuts to boost, credit activity and consumption. That didn't happen. So it doesn't seem like China can do rate cuts at this time, or that they're not willing to do the rate cuts at this time because of the currency. We talked about that also a little bit, how the stronger dollar is actually putting pressure on most economies. Now, we saw their yields actually hit rock bottom as well because of this fear for the economy, right? Things are not going well. Now, this month is very important because July 15th to 18th brings the third plenum. This happens every 5 years, and it is a very important, reform policy setting meeting within the CCP. And so big changes are usually made during this meeting. And so everybody's looking at what may happen next. Now, equities usually start to decline going into the meeting, and we see a little bit of a pop after the meeting. And that's probably because, finally they bring some measures that can probably help the market. We'll see if that happens. We don't expect any bazooka stimulus or any huge policy initiatives. We think there will be gradual changes, but some of those announcements may actually bring a bounce to the market. So let's watch out for that after July 18th. Now, long term, we still have all these problems in China, right? So short term as well, we're underweight. We thought the cycle was changing. It was meant to be inflecting, but we're seeing that pull back again. So while industrial production keeps going up, the domestic economy is not doing well, and that's sort of bringing stocks down again. So I'd be very cautious when it comes to China in the short term and in the long term. Until we see meaningful changes, it's going to be very difficult to find a direction in stocks. We might see short-term rallies, which we can trade, And we look at that on a week to week basis through our dashboard. But taking a more firm, longer term position, or even a 6-month position, can be tricky. So, and then next up we have India. Now, India, with the elections behind us, seems like it's smooth sailing, but not so much. Now, on the good side, on the positive side, I want to say that, this non-sweep election, so there was an issue with the elections. Prime Minister Modi didn't sort of win by the outright majority that everybody thought he would. There were some issues there. There is some waning in his popularity. And part of the reason for that is rural poverty and youth unemployment. So these were the two issues that were kind of sticky points. He's been doing a lot of infrastructure spending and all of that, but the rural farmers are struggling. And so now he's sort of putting in policies in place to boost some of that rural activity, particularly because they have been hit really hard in terms of weather changes and this El Nino and, erratic monsoon seasons. This is also what's keeping food inflation quite high in that country. And another reason that the Reserve Bank of India, their central bank, hasn't been able to cut or start their easing cycle like many of the other developing countries. Now, in terms of stocks have been rallying like there's no tomorrow, right? Now, one of the reasons for that has been that input costs have been coming down. So if you look on the right side, the chart below shows you the wholesale price index and how it's come down. Much of this also has to do with wages that hasn't been increased, right? And that's why the chart above shows you where profit margins are compared to revenues. Now, some of that is reversing, right? The costs are going up. Wages have started to correct themselves, or let's say, have started to correct, adjusting for inflation. And this could actually put pressure on these profit margins and therefore the stock. So we might have a more challenging earnings season, if not this season, then next season. And that's something to be a little bit more cautious about. Markets are at an all-time high anyway, so taking some profits here may not be a bad idea. It may not be a bad idea to also remain neutral until we see whether this fiscal policy, this new fiscal spending kind of offsets the declining liquidity and the corporate profits. Finally, we think the RBI will not be able to cut until Q4 and probably in line with the Fed. And so we're still overweight India in the long term, but in terms of the short term, we want to be a little bit more cautious.
And India was an area of opportunity that we identified a long time ago for our members. It's been an absolutely raging rally. So folks, when you get those kind of gains, you've got to be the polite person. You don't want to be greedy. Greed can get us in trouble. So taking some profits here, downsizing to about equal weight as we wait for opportunities to potentially allocate at better prices. This is how it's done, right? The trades worked. It's been great. There's all kinds of macro catalysts over the long term, but in the near term, as Aisha said, take some profits. So next up, we have Mexico, and Mexico is an area where we're honestly a bit disappointed, not with necessarily the results of the election, but the reaction function in the market, assuming that this is going to be a government that is much more in favor of meddling with some of the components of the economy, giving more state control. We don't necessarily see that as being as high risk as what's been priced in, but we also have to respect the momentum. It has shifted to the downside. It's been favoring sellers pretty aggressively. So we've de-risked Mexico. We're looking for a new opportunity to get back long. We're also looking for more clarity on the political front because, we saw what happened in Brazil with Lula. We saw how his fettering with Vale and Petrobras really reduced confidence in the economy. And I think investors globally are looking at Mexico in a similar light. They're also looking at Mexico as a big exporter like South Korea and saying, boy, if the economy slows globally, what's that going to mean for Mexican equities? Mexico is also a decent-sized energy producer, so it's sort of sensitive to those cyclical flows. So we're looking at this as, let's sit on the sidelines, let's find an opportunity when there's some greater clarity to get back long. Long term, the story is still intact. Short term, caution is warranted over the next quarter to see how the agenda of new leadership takes place. But believe me, if we see things shape up and become more constructive, we'll talk about it on our weekly dashboard and we'll revise our views. So last up, let's talk about Brazil. Like Mexico, Brazil's economic uncertainty is elevated as the current leadership shows signs of veering more towards increasing state control of key companies like Petrobras and Vale. They're the biggest weightings in the Brazilian Bovespa. So it matters for their equities. And this type of government planning and control often leads to unintended consequences, such as reducing foreign investment and slowing economic growth. As confidence reduces, you get people wanting to move their money elsewhere. And initially, we saw flows into other Latin American countries, but now we're starting to see just generally investors becoming more cautious of the region, and especially Brazil and Mexico. So over the next 3 months, over this quarter, we're underweight Brazil. We believe that if folks have long positions, de-risking makes more sense until we get more clarity, because we're just in a period of time where there's a lot of unclear policy potential decisions that could undermine the economy. We don't want to necessarily be long into that. So we're looking for opportunities once we have better clarity, if momentum improves, to see where the dust settles and if there are opportunities to the upside. But for now, we're cautious on Brazil, and that's over both this quarter and the long term, unless and until leadership considers more free market friendly policies. So we want to thank you for tuning in to our MacroVisor Q3 2024 Global Outlook. For more information about the actionable strategies that we have in place for all that we've discussed and much more, consider becoming a member of the MacroVisor website. We have a sale going on right now for about 30% off. You can become a member. You can take advantage of a lot of the insights, our permanent portfolio, our dashboard, the ideas that we share for trades and investments over various time frames, and our analysis. We love what we do. We're passionate about it. Our belief is that macro, meaning momentum, creates some of the best trading and investment opportunities out there, and our track record proves it. Aisha, my business partner, was recently featured on Fox News, and Charles Payne complimented the hit rate of her picks. They are absolutely out of the park, of our picks, I should say, because they really represent both of our views, right? So this is what we do. We look at the markets, we have our top-down view, we have our momentum-driven view. We correlate between the two to validate our ideas as being valid through price action and theory, and then we share those ideas with our audience. So thanks again for tuning in. You can learn more by visiting MacroVisor.com. If you have any questions about our retail and institutional offerings, you can write an email to hello@MacroVisor.com. You can follow us on Twitter or X or whatever it's called these days at The MacroVisors, and on LinkedIn at linkedin.com/company/MacroVisor. Thanks again for tuning in. We'll catch you soon.